ESG stands for Environmental, Social, and Governance Investing. In simple terms, these are a set of standards that investors use to screen a company's potential investments. I'm Amani Maalouf, a senior researcher in spatial finance at the Smith School of Enterprise and the Environment at the University of Oxford. Today, in our quick climate dictionary, we're talking about ESG. This means choosing to invest in companies that are not only profitable but also responsible. Investors use ESG metrics to assess risks such as climate liability, labor practices, and align portfolios with sustainability goals by looking at how a company impacts our planet and treats its people and communities. While there isn't one single global body governing ESG, various organizations, rating agencies, and governments all contribute to setting and evolving these metrics. For example, investing in a company committed to renewable energy and fair labor practices might be considered ESG aligned. Supporters believe that ESG helps identify risks and create long-term value. Critics argue it can be vague or used for greenwashing, where companies appear sustainable without real action. ESG works best when paired with transparency and clear data. A key barrier is that standards vary and it's not always clear what counts as ESG. So why do financial institutions and companies care? Well, issues like climate change and nature loss pose significant risks, impacting company values and the global economy. So investing with ESG in mind can help manage these risks and unlock opportunities, with ESG assets projected to reach over $40 trillion by 2023, according to Bloomberg. However, gathering reliable ESG information can be challenging, and companies often self-report, and the data isn't always standardized or up to date. That's where our team at Oxford come in. We're using geospatial data like satellite imagery and artificial intelligence to develop global databases for different sectors to independently assess environmental impacts. For instance, we can analyze satellite images of a facility over time to monitor its emissions, impact on nature and biodiversity, or assess deforestation linked to a company's supply chain. This allows us to map supply chains, identify high-impact assets, and detect hidden risks and opportunities in key industries, providing an objective, real-time look at their environmental footprint. This should improve ESG ratings and provide clearer, more consistent insights for investors, and this approach helps us to overcome current data limitations to build a more sustainable financial future.